We've heard of gold bullion, silver bullion, but diamond bullion? How do you price it and why does it make sense?
Yeah, I think it's the first time in history that diamonds have been commoditized into an investment product and traded on a regulated electronic marketplace, a regulated exchange, where people trade other sort of commodities. The diamond bullion contains investment-grade diamonds, which are the top colors and clarities, and they are sourced, and the pricing is the big issue. They are sourced at wholesale price. So the first thing we need to understand is that in the diamond market, there's no price transparency at all. Diamonds are still traded manually. And from the wholesale market price to the retail market price, the difference is as high as 4 times. So we have 20 billion polished diamonds produced annually. The same diamond, when they hit the retail market and are part of a jewelry piece, becomes an 80 billion. So the question, there are 2 fundamental questions. Even if you want to buy a nice big stones and you say this becomes my portable investment, at what price did you purchase your diamond? Where are you into this huge range? And the second question would be, if you want to sell it back, where do you go? There's no marketplace today that will price it accurately, where you can buy and you can sell back your diamonds.
You're talking about standardization and regulating, but can that happen? Many attempts before have failed. We've had the diamond index, for example. That didn't work. Why would it work this time around?
Well, number one, this is what creates pricing and fungibility. Number one is you assemble a certain number of identical diamonds into the bullion. You provide full pricing transparency. What price is diamonds are being traded on a spot market? What price is the diamond bullion being traded? So to commoditize market, it's not just about assembling diamonds into a bar or into a device. It's about providing spot pricing transparency. I need to know at every second, like gold or any commodities, what prices diamonds are being traded on a regulated market.
And technology is allowing you to do that.
Technology is what is the breakthrough in this. The technology is twofold. First, the first breakthrough was to create a regulated traded exchange, which is no different from a commodity exchange. So we have regulation rules, we have settlement banks, brokers. The second technology breakthrough was to create a technology process that with your mobile phone and the mobile apps, the phone would identify the diamond, would tell you what the GIA certificate are, would connect to the exchange, would give you the spot trading price of the diamonds.
But Alain, technology is also allowing laboratories to come up with synthetic diamonds. Would that diminish the value of diamond investments?
Yeah, it will actually, on the opposite, increase it. The synthetic diamond which are produced today will find their way into a jewelry market for affordable jewelry. But synthetic diamond have no resale value. So if you buy synthetic diamond, again, you would never be able to resell. When you do an investment, you look for capital appreciation, you look for liquidity, you look for preservation of capital, and the thing you want to avoid by most is volatility. But you need an exit door. Where do you sell these diamond back? So these diamonds will never reach the exchange. We have quality control process in place with both GIA and the base technology. So we are 100% sure that the diamonds that we put in the bullion are natural diamonds.
You talk about liquidity. It can't be liquid right now. It's a new market. Why would I get in? Why would I invest in diamonds right now?
Okay, 2 reasons. Number one, we had a low price in the history of diamonds. For 6 years, the price of diamonds have been going down. So this is the right time in terms of pricing in the history, in the cycle of diamonds to buy. Now, the liquidity, of course, is the question that everybody would have in mind. It's a legitimate, important question. I think if I do an analogy with gold, do you know how much gold was traded in the early part of the century? About 250 million of gold was traded. How does that compare today? 200 billion of physical gold is being traded annually. What happened so the liquidity at the beginning was very little. What happened is primarily 2 things. How did we get from 200 million to 200 billion? The banks, the central banks and the banks played a critical role. They created gold as a physical investment, tangible product. They created coins, gold bars. And then in the early 2000s, the market jumped from 20 billion to 200 billion because the banks created what we call an ETF.
But when do you see liquidity setting in? Because right now, only 2% of diamonds are traded versus gold, which is 60%.
Okay, so let me correct that, Linda, if you mind. Only 2% of diamonds are purchased as an investment purpose and destination. And these diamonds are primarily the fancy colored diamond that you buy from auction house. They're not traded. So that is the key. If you buy such a diamond, where do you sell it next to make your profit and to be liquid? You can only go back in 5 years' time to another auction house and because of the rarity of the diamond, hope that someone will buy it at a higher price. So the liquidity, you need an exchange. You have a two-way pricing market. So only exchange, commodity exchange, can provide you the liquidity that we need. That's what we have put in place. And we have started about 15 months ago trading single stones and baskets of diamond. Up to, we're getting close to 200 million. So the 200 million reminds me where gold was traded 100 years ago. And in the last 40 years, the gold price increased by 40 times. Why? Bank made that market happen. And the diamond will follow exactly the same trajectory.
Alan, I have to jump in here because the entry point is $100,000 to $200,000. It's not for your mom and pops.
It is.
Where's demand coming from?
It is. It is and it will be. So the way we're going to distribute this product is primarily through private banks at the beginning. So our discussion with private banks and our market research and even the Bears market research are telling us that the entry point level for an investor at this point of time who understand the fungibility, the tradability and liquidity is 100,000 US. That's quite a sum of money, right? Agree with you. What's going to happen next is the same thing that happened for gold. In early 2000, diamonds banks created gold ETF. So I know that banks are already working on the diamond ETF. So you will be able to own a fraction of a physical diamond inventory for much less than 100,000. This is the next step, and again, it's the banking industry that will create that market. So you may not have to need 100,000, which is quite a sum of money. When diamond ETF, which are ready, will come in the market, you'll be able to own a fraction of $1 billion. But the entry point first is to go through the banking system, and they're telling us entry level is 100. The next way through ETF will allow you to buy a fraction of that.